whether it's about inflation, interest rates, the economy, or geopolitical tensions, investors want safe havens. And so they'll go to gold, which is the ultimate safe haven, which is actually the best performing asset in 2024, as well as also the best performing asset so far in 2025.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And fortunately, I am joined today by Greg Crennan of the Coastal Journal, who tracks not only the gold and silver markets, but also the stock market and some of the tech stocks, especially as we had, the obviously interesting news with DeepSeek AI last week. And we'll talk about that as well as what impact that could have on the metals, because I think that's happening at an interesting time. And certainly when we see stocks fall, it's often a very common reaction that you have on the retail level of gold and silver. So we'll dig into all of that and more. We'll talk some tariffs and Doge board and a lot of the things that are happening quickly by the day. And Greg, sure is a great time to have you on in here today. And how are you?
Thank you, Chris. Looking forward to maybe shed some light on some information for you and your viewers today.
Well, I am glad you're here because there's certainly a lot of confusing things happening out there in the worlds and the financial markets. And this call, you're probably hearing it Wednesday if you're watching at home. We're recording on Monday night, and you can see gold had quite a good start to the week, up $20, and silver up as well. Again, a lot of that will change. We also have the labor report on Friday. Greg, perhaps we could touch on that before we wrap up as well. But first, just to start, we have gold 28.54 and silver down here 32.50. Anything that you would like to start off with on the metals, just in terms of how they've been rather volatile in the midst of a lot of uncertainty in the markets, which especially after seeing tariffs on Mexico over the weekend. And well, not just yet. I mean, it's a difficult environment to know what's going to happen next, even after a decision has been made. So, why don't we start there with the metals and your thoughts on how this has all been playing out?
Yeah, so a while back, you and I discussed about how gold moves actually. And many people associate gold with inflation. But really, when we last spoke, we talked about how gold is actually a fear gauge. And what we mean by that is when investors are worried, whether it's about inflation, interest rates, the economy, or geopolitical tensions, investors want safe havens. And so they'll go to gold, which is the ultimate safe haven, which is actually the best performing asset in 2024, as well as also the best performing asset so far in 2025. And so it's a little bit different when you look at gold versus silver, even though that silver had a great year last year, it's off to a great start this year. Silver isn't really known for that fear hedge. And so even though gold and silver are always usually talked about in tandem, silver doesn't usually get the safe haven status that gold gets. And so when you have the markets like we're currently having today, many people will want to move their funds around and buy gold as a safe haven. So investors globally will buy gold, especially now that you have countries with Trump going into these trade tensions, and you don't know where these tariffs are going to be. So it's not just about Americans, it's about a global trade where people will then ditch their fiat currency, whether it's the peso, the euro, the yuan, the yen, and they'll buy gold because they don't want to deal with the currency fluctuations in the foreign exchange markets, and they'll be buying gold. And that's kind of like what we've been seeing in the gold price. And that's kind of like also why, even though gold's at a record high today, silver is still like 29-30% below its all-time record high. So, it's a little bit of a different market when investors are seeking a safe haven asset.
Yeah, I know what you mean, and a lot of great points you had in there, and certainly that we have seen the world turn to gold, especially since the sanctions on Russia in 2022. We've seen countries turn to gold, unlike most of our lifetimes, and most of us who are alive here. I don't think there was another period where we've seen quite like that in a while, and have not had that on the silver side yet. So obviously a different dynamic. Although, Greg, one of the things that, and I'm going to pull this up in the background, I mentioned the DeepSeek AI, and certainly I know you follow the tech stock. So if you have any comments in general about that, by all means, you can add those in as well. But the main thing that, as someone who focuses on the metals that stood out is that what really gets people buying physical gold and silver is stuff like the banks collapsing, the Nikkei down 12%. So, now we're in an environment where for the last year and a half, we've had a lot of selling on the retail level, and I wondered what changes that. Although, if we ever did have a sustained downturn in the stock market, especially if it was a sharp one, again, perhaps something more extended of what we saw last week, at least now how that affects COMEX futures might be a different story, but at least in terms of what people would actually be doing with metal, that would be at the top of the list. So long question there, but any thoughts on how what you saw last week, what you think we might be wise to watch out for in the future, and then that how that plays back to gold and silver?
Yeah, so I'm not going to get into the intricates of DeepSeek AI, but as far as just going overall valuations of the market and the AI related stocks in general. So if you look at previous cycles, when valuations got so high like they are today, which would have been at the 2000 peak of the dot-com bubble, in that after it rolled over and started to climb, interest rates actually started to fall, kind of like what we're seeing now with the Federal Reserve and their interest rates, right? Well, right now they're on pause, but usually if the Fed's cutting the interest rates because they're worried about a slowdown in the economy and the stock market's rolling over, well, that doesn't leave many investors with too many options. And so,
Oh,
if you
well, Greg, I apologize for interrupting, but Jerome Powell, on more than one occasion, explained that the economy is still strong. There is, according to him, no indication of anything that could lead to an elevated probability of a downturn. So,
Right. So, of course, when you're throwing around tariffs like you're giving out candy on Halloween, like Trump is right now, that's going to turn a lot of uncertainty in the market, especially for businesses and corporations. It's going to affect things like investments, CapEx, spending, hiring, not hiring, or even layoffs. And so, if the market does roll over here, and you're going to see a possible, I think the Nasdaq now is down about 5% from its all-time high. So if it were to fall another 15% from today, gold may actually continue to grind higher. Now, I'm not calling for any crazy prices of gold, but as a investment, people will, I like we're seeing, will continue to buy. I think the markets opened up down today, and the price of gold was up today and is at a record high. And try buying any physical gold, and I think the most places where you can get a physical ounce of gold today, whether at Costco or Walmart, is around $2,900 an ounce. So we're seeing this record high gold, and where if you were to have me on 4 years from now, I'm not going to say that gold is going to be some astronomical high number. But just like I said, 4 years ago, the price of gold, not even just 4 years ago, just last year when we spoke, I think gold was around 2,000 or $2,100 an ounce. And I said, if you were to tell me if the price of gold was going to be higher or lower than today, I said higher. And I pointed mainly towards the deficit. I said these deficits and debt that we're running at the time, I think was about 34 trillion. You fast forward to today, it's now like 36.5 trillion. So we've
yeah.
added about another 2+ trillion of debt in just a year. And so what that is doing is it's causing inflation and devaluing the dollar as there's more dollars circulating in the economy. And so what gold is really doing is it's just keeping up with the money supply that is being circulated in the economy. And so, gold is still 1 ounce of gold, but there's just more dollars now in the economy and the global economy as well. So, and when we're looking forward and looking at, well, if the market does downturn, gold will, those dollars, when people are selling from the market, are going to put them somewhere. Now, with interest rates coming down and maybe investors not wanting to take the current risk of on the long end of the bond market because they're not really high enough for people to get excited about. Interest rates right now are around 4.5%. And so that isn't high enough to attract a lot of investors. And so they'll take their money if they sell their stocks. And we're seeing some of that rotate into gold.
Yeah, and Greg, I'm curious, how do you think I'll pull it back up? I think it's a little bit higher than when I had it up here the first time. What is the end of this? What is to me it seems like there's some sort of restructure inevitably. I think that part's just math. Now, if you tell me they're just gonna print along and nudge things for another decade or two, I think that's longer than it could go, but I could accept that. Yet, what do you think is ultimately done with this? Oh, and look at this. Did you see we have a Doge clock now?
Yes, we have
How
Elon Musk
exciting.
Doge stock, which is supposed to be tracking the amount of dollars that the current administration is now focusing on eliminating and cutting wasteful spending. And hopefully, I do hope that they are successful in what they do. But you can have, these are just numbers and it's math. It's really hard to cut the amount of spending, especially when if you look on you have up there in the center, it says the interest on the debt. The interest on the debt is now $1 trillion a year. And so with interest rates at the current level, we're paying alone 1 trillion, which is actually, if we're looking at it, it's now more than what we spend on defense. And obviously Medicare is number one, Social Security is number two, and then interest is now number three, overtaking defense spending. So there's a lot of spending going on. That's okay. Now, this leads to one thing. You ask this is what I do. I do analysis. I'm looking at, how can this be done? And as far as what history tells us is that this is the status quo and nothing's going to change. And we're seeing the effects of it, which is inflation. So when they're reporting these headline inflation numbers, they may not actually be so eye-whopping anymore. The only eye-whopping inflation numbers was really in 2022 when the inflation rates were being reported at like 9%. And now the inflation rates have come down to say about 3%. But that's not stopping things and really telling the full story, which is the compounding effect of inflation. And what I mean by that is when you get hit with that insurance cost on your car that goes up, say, 20%, you're not going to get back 20% in the future. Like it's now 20% and it's going to stay 20%.
Not
Same
as
thing with,
transitory as they would lead you to believe.
right, it's not transitory. You're now stuck with that 20% higher on your auto insurance. And so if you weren't prepared for that 20%, you have to figure out where you're going to get that extra 20% from. And then you do that and you multiply that through everything that we buy on a daily basis. So all these price increases that we've experienced since the government increased the money supply from 15 trillion to about 28 trillion today. I think it's 27. No, oh, I'm sorry. 22 trillion is what the money M2 money supply is supposedly. So we went from 15 to 22 trillion from
Well,
2022.
we're close. We might get there before the end of the
Just under.
call, but
Yeah,
yeah, we
right.
got they've added a few new cool fields here that I haven't seen before, but here we have the currency and credit derivatives too. But yeah, anyway, we're close to 22 and M2 and
Yes. And so with that money supply increase, people are recently complaining about the price of eggs. Well, the price of eggs didn't go up during the first wave of inflation that we had. And so the price of eggs are really just catching up to the previous supply and demand that was in balance. So, pretty much all the goods are rising about the same price based on the increase in overall money supply. And now, when we look forward in the future here, and what's going on is, well, how are we going to pay this off? Well, there's really, government is funded through taxation. And so, if you're not raising taxes on the individual American, where are you going to get that additional taxation from? And that is where tariffs enter the picture. So, these tariffs that I believe that Trump is presently using is to raise tax revenue, which is great because then technically it can help fund and bring down the deficits. It can possibly pay, if they raise them high enough, could pay down the debt. The issue is that companies, it's a taxation on companies. Now, a lot of people are saying that the taxation that these companies are going to have to pay when they import these goods are going to be passed along to the consumer. And it depends. And there's a lot of factors. And that's what a lot of companies now are in their exec rooms and they're coming up with all kinds of analysis on what to do. Now, the simple answer is, well, if I have to pay as a company, let's take Apple. And I really recently wrote about that last night, and you can read it on the Coastal Journal about how tariffs are affected. So if Apple gets hit with 10% for importing their goods on China, which is supposed to go into effect tonight, then Apple, to bring in their products, needs to pay the US customs an additional 10% on all their goods that they're importing. So Apple will pay that 10%. Now, what Apple will do is, well, we can eat that cost and keep the price of the iPhone the same. But what does that do for Apple? Then it reduces their profit margins. And so that means Apple would make less money or less revenue, which then would hurt the shareholders, people who own the stock, because now they're making even less revenue. And so Apple, if they increase their prices by 10% just to offset that cost for them, they can actually hurt demand. So if an iPhone is going for $1,000 and they have to raise it to $1,100, it may actually scare away customers. And so then they hurt in their sales volume, which then hurts their stock price. Or they could do something which no one talks about. Companies can do layoffs. They can say, hey, let's cut off 10% of our labor because maybe we don't need as many people. And if we look at recently, companies have been laying off people. So it could affect layoffs. Well, then if layoffs increase, that's less people working and that's less people having an income. And then that hurts the overall economy. So or they can do a combination of all three or four options. 2% price increase, 2% reducing layoffs, and then we'll eat the other, percentage wise. So they could do a combination of all three. And so it's not just about prices and what you and I will pay, it's how it affects the overall economy. Apple may say, well, we were going to invest in the economy, but because we have to pay 10% more, we're not. So their CapEx could spend less, meaning like maybe if they were going to build a factory, they may stop their spending. So then that trickles into the real economy. So there's definitely different options, and tariffs are more than just what we'll pay at the store. And I think that is what is not being reported and not being informed because the simplest thing that grabs headlines is tariffs equals price increases and not talking about all these issues that we are talking about today.
Okay, well, appreciate that and good overview of some things to think about there. And Greg, I guess the last one I wanted to go through with you is that we have Trump saying that inflation's too high. He also wants lower interest rates. And firstly, I thought it was funny a week ago he was saying that. I know more about interest rates than the Fed does. And in either case, along with a variety of other factors that you've mentioned here today, it seems as if there's a good shot there's more inflation on the way. And do you see another wave similar to what we just had a couple of years ago? Partly just because it's worth considering in its own right. Although I wonder if that happens, is that perhaps what it's like each of these ones we've had new people come into the metals. But especially if we have another wave of inflation similar to what we just went through that did open a lot of people's eyes, I'm wondering if that's what gets the person who still has never thought about gold and silver, some more of them thinking about it. But what would you say on the inflation path going forward?
So, I'm a simple math guy, and so I keep inflation focused with the deficit and def and the money supply. But as far as what actually is being reported in the indexes that are in the monthly headlines, there's really a couple of things that drive that, when we hear those, inflation was 3% this year or 4% on a year-over-year basis. And that is actually coming mainly from things like the shelter cost, which has basically been stuck at about 5% for like the past 2 years. And so it was 5% last year, 5% the year before, and actually shelter costs didn't really rise during the first like wave of inflation because they do things called like the owner equivalent rent. And so that's really been stuck around 5%. The other main contributor is oil and energy. And so the issue is when we look at these indexes, and like we were talking about, our auto insurance went up 20, 30%. Our electricity bills went up 20%. Those things on an index base, when we see those headline numbers every month, are very small because they take all those price increases and they have very limited effect on that overall year over year number. And what happens is if energy or oil is flat or negative, it brings down that percent increase. And that's what I try and do when I write for the Coastal Journal is when I break down these inflation reports, I go over the details of, hey, this is really expensive and it's not really being reported because they said, well, oil on a year over year basis, because the numbers are on just a 12-month change basis. And so because oil shot up to 120 in 2022, and now oil is trading at about $73, it's been declining since that peak of 2022. And so those negative numbers on a year over year basis continue to keep the reported inflation down. So it's kind of like a magician's trick on like how, we go to the grocery store and we're like, wait a second, why is this up 10%? Why are utility bills up 10%? And the government's telling us inflation is 3%. And it's because oil and energy make up a big portion of the index that it skews the index one way and it also skews it on the other way to the upside. But the thing is, when oil or energy goes up on the upside, people have to pay for that cost, and then it brings the cost of everything else up with it. And so when you're asking me where I see inflation going, I just see inflation being stuck around this reported percent around 3, with it possibly going as high as 5 this year. But unless oil, and I was just looking over at the numbers today actually, oil would need to go over, I think, $90 a barrel to have a positive effect on the CPI inflation number. And so if oil stays below 90 for the year and even goes lower, we're going to have continued negative energy prices on a year over year basis, which will actually keep the CPI percent lower than what you and I would actually, and your viewers would actually experience when we go to the store on a daily basis.
Okay. Well, that's certainly helpful. I know you dig into the mechanics of those formulas quite a bit and getting an idea of, like you said, whether that's accurately measuring the true level of price increase, probably not, but at least in terms of having that gauge for how the market will react to some of these things. Quite helpful. And Greg, perhaps just in wrapping up here, you could let people know about the Substack and where they can find you on Twitter, where you're quite active and entertaining as well. And so there is the Substack, and maybe you could tell people a little bit about it.
Great. I hope you and all your readers continue to subscribe and read. I try and, like I said, go into more detail on like what we've talked about today. I pull up all real data, facts, so that you can make informed decisions, and also understand what you're doing, what you're buying, what your value is on your investments from stocks, precious metals to bonds, and also understanding the economy, what we're doing, the deficit, debt, and keep everyone in the loop. Because, like I said, no one really explains, like we were just talking about, those inflation numbers are being skewed. And so that's type of the insight that I want to bring to everyone so that they're informed and that they can stay aware of whether it's them personally or their investments that you can't really get anywhere else.
Well, I sure enjoy reading it. I am a happy subscriber, so I'll be happy to mention that in there. And either case, Greg will also put your Twitter links below where people can find the Punisher of Wall Street for the personal commentary. And then direct from the Coastal Journal, we have one Coastal Journal. But I'll put the links in the description field below, and hopefully people can go and enjoy interacting with you. And you do put out a lot of good information and remind me a little bit of Kranzler, where not just the gold and silver, but the tech stocks and how, I mean, they all interplay with each other. So in either case, I appreciate you making some time to join us here today. And Punisher, go out and stomp on some of those Wall Streeters for us. And but thanks for making some time, and we'll do this again soon. Well, thank you again to Greg for today's interview. It's always fun catching up with him. Good guy and certainly a great analyst, and grateful that he comes on and shares some of the other things that I don't dig into as much, but he certainly has quite a level of expertise, and highly recommend taking a look at his Coastal Journal on Substack. And real quick before we wrap up, I would like to thank First Majestic Silver, who was the kind sponsor of today's show. And they had some exploration results out from their Navidad project at Santa Elena, where they have significantly expanded the gold and silver mineralization discovered at the Navidad target. And that also comes along with high recovery rates, 90% on gold, 85% on silver. Here we see Keith Newmeyer mentioning the exploration program has successfully expanded the high-grade gold and silver mineralization of the Navidad discovery, extending it closer to the Ermitaño mine infrastructure. And they are looking forward to continued success in 2025 as they will be out drilling and continuing their exploration work there. And real quick, you can see some of the results here at the winter vein. You see 4.83 meters at 8.6 grams per ton gold, 3.3 meters, 7.09 grams per ton, and 1,253 grams per ton silver, 2.66 meters at 13.93 grams per ton gold, and over at Navidad, 3.24 meters at 13.06 grams per ton gold, and 205 grams a ton silver in there as well. And again, the link to this full press release in the description field below, so you can take a look through the full results, as well as the maps that give a better idea of some of the geologic work that they've been doing that has helped them to get the results that they are sharing there. So again, the link in the description field below. Hope you enjoyed the show today. Thanks as always for tuning in, and we will see you again soon.